In studio is the redoubtable Rob Tarwell, portfolio manager at Sasfin, and on the line Victor von Reiche, portfolio manager at Citadel. Rob, hold on to your cats. Are you going to be buying into that bounce, considering what we've seen over the last week?
It's difficult. I mean, the volatility is so high and the moves are just so aggressive. I think long term, if you take in views, you can start to look with new money at one or two opportunities in the market. But it is very difficult with the coronavirus to know what the next 6 months is going to bring. And, especially in the US, with consumer spending, it's very difficult to gauge where that's going. That being said, though, the amount of stimulus already been put into the market is about $150 billion between World Bank, IMF, China themselves have put $113 billion in on top of that. So it's, there's huge money coming into the system to try to help the system and prop up the system while this amount of fear is around. And if the coronavirus didn't explode as people are thinking, there's going to be a lot of money in the system. So it's an interesting time at the moment.
A lot of money in the system at a time when a lot of that money is quite cheap, 50 basis points cheaper in the US in particular. Victor, we see this sharp turnaround in sentiment comes as governments around the world are preparing these interventions. We've got US President Donald Trump promising a major economic relief package. I think it came as something of a surprise to his aides and advisors. So he was basically giving them 24 hours to come up with something along the lines of possible payroll tax cuts. It's still very unclear, but the types of programs being discussed are macroeconomically significant. If you look at what analysts at Citigroup have said, would you be buying into this?
Good afternoon, Michael. I think you have to be extremely circumspect in this market. We don't know how the corona situation will develop in Europe and in the US, as Rob mentioned. Obviously, the US consumer is key to that economy and world stock markets. There's no doubt that central banks are throwing everything they can at this problem. I think you have to sort of take a step back and recognize that we are talking about supply and demand destruction here. And that's very, very difficult to resolve for central banks. I mean, they have conventional tools. They've exhausted most of that. And I think it's fair to say that it probably is a time to be circumspect. I think what's different to maybe in the GFC is that investors could step 10 years ago onto the sidelines and be compensated for owning fixed income. You had general good yields, and what will be interesting this time is to see how long investors can stay on the sidelines and before they're being enticed back into stock markets. As there's obviously income needs, you're talking about baby boomers retiring and so on. So I think from our side, it's definitely time to be circumspect and maybe use the rallies to sort of de-risk, we would say.
Rob, that said, we spent a good deal of yesterday's program talking about the negative impacts on what an oil price at between $20 and $30 actually portends for the global economy. But there are some upsides to an oil price at that level, particularly here in South Africa with such big oil importers. So hopefully some of that relief will at least stimulate the beleaguered consumer.
Definitely. I think looking at one or two economic reports, if oil stays around $36 a barrel, and the rand where it is, it brings our next printing inflation down to about 3.2%, which is right at the bottom of the range of 3 to 6, which the Reserve Bank looks at. So, you could really then start cutting rates in South Africa, all things being equal, which would really help, the consumer in South Africa. So, there is definitely benefits, and, a low oil price for South Africa is significant. It helps us quite a lot around, even if you take a look at the taxi industry as well, that will get relief for the consumer. So it can be very beneficial for South Africa, and with South Africa having such high rates already, we still think people will come in to buy our bonds because yield is now really being decimated everywhere else in the world. So we might get a situation where we get some rand strength and not a blowout of the rand as people come to look for this yield. So it'll be interesting to see how much offshore buying comes into our bonds.
It doesn't suit you, however, if you're a Sasol or Sasol shareholders at the moment. And Victor, if you look at what's going on with Sasol, it had scheduled to host a conference call today at around 3 o'clock, and that was really to discuss the recent outcome of that ratings review by S&P Global and Moody's, where it was cut to junk. And obviously, given the latest developments of where oil prices have declined massively, we saw 30% down yesterday. That's its biggest fall in 29 years. It delayed the conference call till next Tuesday. It's been a week, effectively, delayed by a week. Down 16%, Sasol, on a day when we did see the oil price bounce back. So the market seemed to be saying that they're going to rush through a rights issue before the 17th.
It certainly looks that way. I think 6 months to a year ago, investors were focused on the potential for the cracker to add to earnings significantly. And I think the focus has shifted squarely to the balance sheet. I think at current spot prices, there is definitely a distinct possibility of a rights issue. I find it surprising that management didn't hedge the oil price. They talk about protecting the balance sheet. You hedge the currency, you hedge ethane prices, but arguably your most important commodity you don't hedge. You see a significant plunge and it immediately endangers or imperils the balance sheet. So I think at current spot levels, there's a distinct possibility for a rights issue. There's obviously very little appetite for that. At the moment, if you look at where the market cap is trading, I think I looked today, it was trading around a third of net debt outstanding. So 45 billion rand market cap. You'd have to place, if you do a rights issue, place that at a discount, and then the share will probably settle lower than the theoretical rights price. So I think investors simply not having a stomach or something like that, and you saw the share come under significant pressure again today.
Rob, what other options are on the table for Sasol at the moment? Lister Mainshe said yesterday they could potentially sell off the Lake Charles project. They're on the hook for a lot of that debt, and effectively, if they get a deal with a potential buyer to take that debt as well, you're left with the South African assets, and even those are worth certainly a lot more than 71 Rand 67.
Yes, they could sell the cracker, but it's not running 100%, and they're going to have to sell it at a discount. If it was producing really good cash flows, you could get a forward earnings multiple out of that, and you could get a decent price. But it'll be a fire sale, so I think it would be something that maybe they wouldn't want to sell. Maybe they've got a few other assets around the world that they could start to sell and maybe prop up the balance sheet with, that they'll get a better price for. But it's a difficult one. I think that if they got buy-in from the larger investors, I see that Alan Gray put a note out to say that they think that there's value in Sasol, and if they backed a rights issue, then maybe you'll see a recovery in that share price. But it's going to be interesting to see who will back a rights issue in this environment.
It certainly looks like bond holders again will be the winners, while equity holders are the ones left carrying the can. I'm thinking of the likes of PPC. We've seen it happen far too often, the likes of Steinhoff. And if you look at the damage to pension funds, I'm sure a Sasol collapse is even more damaging to pension funds than even the Steinhoff collapse that we saw, Rob. So this is a massive story.
It is. It's hardly the stock is owned by most of the pension funds, and most big asset managers have held Sasol for a long time. So yes, it is. I think on Monday when the market opened, I think it fell more than Steinhoff fell. It dropped 50% in one day with no issues to any corporate governance issues that we know of, and there wasn't any fraud, etc. It was just an oil price change. So it was a dramatic move, and I think you're starting to see also a lot of. You saw today that it went into auction a few times, and I think that there's quite a lot of derivative action happening now where people are having to cover margin calls. There's some forced selling, so we'll see in the next few days where the actual price settles down.
Another interesting story was Assel going private after 70 years on the JSE yesterday. We didn't have time to get to it, Victor, and it just continues this theme and this trend that we've been witnessing over the last 5 to 10 years on the JSE of delistings. Great for shareholders, a fantastic almost 80% premium, but our investable universe as retail investors in particular is just dwindling by the day.
Absolutely, and I think you've seen that trend, as you mentioned, happen specifically in the mid and small cap space, where a lot of listed companies are trading at a discount to private-owned companies. And I think in this environment, investors are just saying, the market is not recognizing the intrinsic value of our business. liquidity is completely dried up. We see that in the mid and small cap space again specifically. And as saw just the latest company to really follow suit there, I think the takeout offer price is extremely fair to shareholders. It will largely be funded from net cash. The company is sitting with over 8 billion in net cash. And you effectively have to I think the settlement price is 7.8 billion. So you can easily pay this out of cash reserves. It's a significant premium, and it includes a dividend. So it's a pity. It's a company with a long heritage and track record on the JSE. But as I mentioned, at the moment, very little appetite.
And then the other big news on the day, Rob, was Vodacom agreeing to cut mobile data prices. Very high-profile, some may say overly politicized story, this around data prices. And if you look at the way the Competition Commission has effectively reading through this, really watered down, softened its stance. With Vodacom now coming out saying it's cutting its out-of-bundle rates by 30%. At one stage, it looked like the competition authorities and Ibrahim Patel were willing to go to war on this. A cut of 30% to 99 Rand for a gig, it certainly won't have competitors quaking in their boots. And you wonder how much of the cuts announced today were really factored into its business plan. What is the impact here on the telco sector?
Well, I think, the competition side, if one of the big players, without anything in the competition board, said we're going to cut data by 50%, all the other players would go in and complain to the competition board that they're using their power as the biggest player to cut rates and blow them out of the market. So I think that the competition board has realized if they've actually forced them to do it, they're going to get rid of the competition, because the competition cannot compete at those prices. So I think that they've had to soften a bit to allow the competition to get to the point where they can also offer data at that price. The thing is, Vodacom can do it. They can take a hit to their earnings, and they're going to get market share again. So, I think that it's difficult to be overly competitive in South Africa. You need one or two big players, 2 or 3 maybe, but in this space, the smaller players cannot compete. And if they cut the prices right down to the bottom, the smaller players are gone.
Rob Telwell, Portfolio Manager at Sasfin Securities, and Victor von Reiche, Portfolio Manager at Citadel, with your view from the market, brought to you by One Fee, exclusive to Outvest. Visit them at outvest.co.za and find out how you can save your investment just by saving on fees. Outvest is powered by Outsurance and is an authorized FSP. T's and C's apply.